Welcome to the Passive Income Podcast. I'm your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. Super excited for today's episode. Joining me is Bob from the west coast of Canada. So, Bob, go ahead and give yourself an introduction.
Hey everybody, thanks for having me on. I'm Bob. I blog under the name TAWCAN.com. That's TAWCAN. TAWCAN was a name I invented when I started using the internet back in the early 90s. Basically stands for Taiwanese Canadian.
Right.
And that's my background. So kind of nobody uses that name, so I stuck with it. And it's a name easy that I could get a handle pretty easily, right? Anywhere,
Right.
Twitter, Facebook, whatever, right? So just stuck with it. I blog about financial independence through dividend income. So our goal is to eventually live off dividends. On the blog, I talk about 2025, so that's a couple of years away. And I think this year we're on track to hit. Our goal is to hit 49,000 in dividend income. Right now, per my projection, we're going to hit that and maybe a bit close to 50,000 actually.
Right.
Actually, for those long time readers on my blog, I don't convert the USD to CAD. So if we do convert the currency, we're over 50,000 for sure. I just keep a 1-to-1 conversion to keep the math simple.
Right.
I talk about dividend investing. We don't just do pure dividend investing, right? So we do dividend stocks. We also do ETFs to help with the diversification. So I talk about that. I talk about financial independence on the blog. Mentality, like how to get yourself ready for financial independence, early retirement. A bit of everything and anything and everything kind of thing. So
Right.
people seem to enjoy reading it. I've been blogging for 9 years now. So
Wow.
in internet years, that's like a very long time. So,
Right.
And it's kind of funny because through my blog, I've been able to connect with other like-minded people, other bloggers, podcasters like you, or even readers, right? So that's been a really cool experience.
Stick around because later in the show I will be bringing up the website and we'll kind of go through it in a little more in depth and talk about some of the things you have, a lot of the things you have on there. So many. Just to be clear though, so everything on there is in US dollars then?
It's in CAD.
It's in CAD.
So we
Okay.
do, we do own, US dividend stocks like Apple, Costco, Johnson, the usual ones.
Right.
And then when I tally my dividend income, to avoid the fluctuation in the exchange rate, I just use 1-to-1 exchange rate. But I'm starting to think I'll change that approach next year, just
Right.
to give me a more true reflection of our overall dividend income. Right? So I'll
Okay, I
probably
see what you're saying now.
just arbitrarily peg the historical average exchange rate,
Right.
and just use that for the monthly updates.
Yeah, so you mentioned $50,000 in annual dividend, which is impressive. That's great. And so that means you have obviously been doing this for several years. I'm guessing at least a decade, if not longer, um, to accumulate that sort of annual revenue. And I guess my thought is, I know you're living in one of the most expensive cities in the world. So where do you, and you mentioned 2025, which is just 2 years away. So I guess what is that number that you need it to be? Is it 60, 70, 80?
Yeah, so if you read through my blog over the year, that number is kind of creeping up a bit. Unfortunately,
Yeah.
We got 2 young kids, so obviously that number will change depending on how the family expenses are, right? So
Right.
originally I kind of target 50,000 to give us enough buffer, and we track our expenses annually. So 50,000, we thought it was like totally fine. And then the last few years, I've been kind of targeting between 50,000 to 60,000. I think 60,000 would give us enough buffer. And despite me saying living off dividends, I mean, we're not planning to just retire and quit and stop working completely. Maybe we'll take a year off and go travel or something. But no, we'll probably end up doing what Mark C is planning. Mark C is another blogger that we become friends with.
Yep.
So he's and a lot of these people that become financially independent, they tend to just continue working part time. So that's what we're planning to do, right? So
Right. You become more work optional is kind of
yeah,
what you're
work
saying.
optional, exactly. So it still have that safety net from your dividend income, but if you need additional income, you can supplement it through part time work or things like that. So you're not tied to having a job that you need that income,
Right.
right? So it gives us more flexibility per se, right? So right now we're targeting 60,000 per my projection. I think we could get there in a couple of years, and to be honest, if we don't get there, it's
Yeah,
not a
it's not
big
the end of
deal.
the world,
We know
right?
we'll get there eventually, right? It's either whether
Whether
it's two.
2027, it's
Yeah, it's end of the day, it doesn't really matter. We'll just enjoy the ride
right.
while we get there.
And just quickly, correct me if I'm wrong, but Mark is at my own advisor on Twitter.
Yeah, yeah,
Yeah,
my own advisor. Yeah,
yeah, he's been a guest here on the Passive Income
yeah.
podcast as well. So it's been quite
Mhm.
amazing the amount of people. I believe we're up to episode 94.
Nice.
So actually 95 individual different people because I had Burton Lanning Dividend Diplomats on, so that was a 2-for-1 shot in one episode. But yeah,
Hmm.
well over 90 people now that I've just had these incredible conversations with. And so, again, I appreciate your time and everything and coming on and having this conversation with me.
No worries.
Let's get into, start at the beginning, go back, like I said, rewind that decade or more. And where was the sort of the light bulb moment, or were you investing prior to having a dividend focused strategy, or I'll just let you take it from there. And
Sure. So going back in times, um, still feel young, but getting up there in age. So when I was in university, so going even further, right? So my dad retired early in his I think mid to early 40s. I got a cousin that retired from high tech in his early 40s as well. Another cousin of mine, she achieved financial independence, but she just scaled back and continued to work.
right,
So from a family point of view, we have always talked about money and how to manage money, how to be frugal. The whole mentality of if you earn $1, you save a certain amount of money. That's always been driven to me from a young age, right? So from a saving point of view, I've always been really good at that. Um, and then in university, I started, you know, investing. Didn't really know what I was doing. Investing in, I can't remember what it was, like an income stock or something. But quite honestly, I didn't know what I was doing. It was just
right,
like following the recommendation, right? So, and then when I got out of university, started working, investing in mutual funds, GICs. Didn't really get into the stock market all that much. Again, maybe had like one or two stocks where I was just holding on for just pure recommendation kind of thing.
yeah,
Um, and didn't really get into it until this was pre-financial crisis, so probably like 2008, 2000, early 2008 ish, 2007. Can't remember
right,
exactly.
yeah, that's fine.
Um, I started thinking, hey, I would like to buy ING. ING was a bank, but apparently the ING was stock was a financial. It was an insurance company, which I obviously didn't do too much research on this. So I bought 100 shares, and then just thought, oh, that's I'll just hold on to it and see what happens. It was paying dividends, but I didn't really focus too much on dividends back
Right,
then. And then the financial crisis hit, and that stock tanked like everything else, right?
right,
I've written about this experience on my blog. But back then, ING was yielding about, I can't remember, like 2-ish%, 3% or something, right? So when the price was cut in almost half, I thought about, hey, do I want to sell the shares and then put it in ING? And then when I calculated, I was like, well, if I sell, I take a big loss. Plus, if I put it in ING, or sorry, in GIC, I will be getting similar yield, right? So why not just hold on to it? I didn't need the money. I was young. I was, working and living pretty frugally. So I was like, I didn't need the money. So I just kept it, and I still have it. ING has changed names. Now it's called Intact Financial, and
Yeah.
that stock has more than triple or quadruple since then. So
And probably raised his dividends a few times along the way.
consistently, exactly. And then the other one, shortly after buying ING, was I bought Manulife. Now that one hasn't done as well over the years, but we kept it. We've been kind of trimming, adding, just via drip and stuff. Like drip is a dividend reinvestment plan. So essentially, once you have enough dividends, each payout, usually quarterly, then you could reinvest additional shares if you
Yeah.
have enough, right? So
Or even
kind of
fractional shares if you don't have enough, right?
yeah. So
Fractional
that's
shares are a
with
whole new ball game these days as
yeah
well.
with Wealthsimple Trade you could do that, but we don't use them, at least not in our portfolios. Our kids use Wealthsimple Trade. But yeah, you could drip and basically dollar cost average do that. So this was, I guess, circa 2008-ish time frame. So held those two, and I just kept holding on to them. But I didn't really pay too much attention to dividend investing. It was just like mutual funds,
Yeah.
GICs, stocks everywhere, and didn't really have a strategy. And
Okay, just
then
hold on. Before you jump
yeah,
into that strategy, I'm just going to make a point here, which there's a great lesson in there where you held on to these stocks through that market downturn. And, so many people sell at the bottom. And the lesson there is, just hold on, ride it out over a 10, 15, 20-year time span. The market's going to go back up. And yeah, so I think, you know, you made the right decision there holding on. Obviously now, like hindsight being 2020, you can look back and say, oh, wow, that um, ING now intact, whatever you said, tripled or quadrupled plus all those dividend raises over the years. So, um, yeah, hats off to you for just stomaching that market downturn.
yeah, thanks. I think, and that's why I've written about this multiple times, is that if you are investing in stocks, short-term stocks are very volatile, as we all know
Right.
it, right? So that's why I've written a few blog posts. It's a couple of things, right? Or yeah, a few things. One is invest with money that you don't need for at least the next 5 years.
Right.
If you invest with money you need in the short term,
You're
you're going
doing
to
it
be
wrong.
forced to sell typically at an undesirable price, right? Because for example, if you invest with your mortgage down payment and then say you found a house and you're forced to sell during February 2020, well, that's not a good time, right? You're
Right.
you're kind of forced. You can't write it out. And then um, some stuff is before you purchase the stock, well, obviously do your research, but think about what the potential upsides are, right? Which most people think about it, right? So people
Yeah.
go into like buy, I don't know, Apple thinking it's going to quadruple in the share price. Great, awesome if that happens. But the two other important things to think about are first one, what are the downsides?
Right.
What could potentially happen if things don't pan out the way you believe, right? So
Right.
that's one. Two, and then the last one is, can you live with the downside? Um, Now, if the stock price halves or drops by 80%, are you going to be able to hold on to this stock and let it ride? Or, things like that. Like you, as an investor, you really need to think about it. Because investing is a lot to do with psychology.
Yeah.
Um, you know, it's not something that you have these like trading accounts that you could trade with fake money online.
Yeah.
and you could do very well with those. But like when you're investing with your own money,
Real money.
that's a
It
different
changes.
ball
Yeah.
game, right? Like when you're seeing your portfolio value going up or down, that some people can't sleep at night, right?
Right.
So how do you prepare yourself for that mentality? That's something you have to work out as an
What's
investor.
your risk tolerance? Like, and that's a question every
Exactly.
person has to ask themselves. What is
Exactly.
your risk tolerance?
It's different for person to person, right? So
Yeah.
and again, that also going back to that original point is that if you invest with money you need in the short term, you're going to be losing sleep
Right.
if the portfolio goes down by even 10%. You're going to be like tossing and turning at night because you need money by a certain date, right?
Right.
So that's an important lesson I've learned over the years.
So let's just keep going through then. When did your strategy shift more to the dividend investing strategy?
Yeah, so then I was single back then, and then met my wife, or girlfriend back then.
Yeah.
We met around just before the Olympics, so like 2009, 2010 kind of thing. And then she was given a book called Millionaire Mindset, which we both read, and then that's kind of the start of our financial adventure, I suppose. Just like I call it the financial epiphany, right? So we started reading books, and I think there was like then we kind of I started reading more blogs and investment books and personal finance book, and I don't know, I can't remember, maybe it was like their Foster book or something, or maybe it was some other books where people were talking about dividend and how invest in things that you use on a daily basis, and
Yeah.
be an owner kind of thing, and that jive with us, and that make a lot of sense. So that's when we started shifting our money into dividend growth stocks. So that's kind of the shift. So around 2010, 2011 timeframe, right? So when you look at our dividend history, you'll see there was like a pretty big jump between like around 2011, 2010,
Yeah.
2011, 2012, just because we were funneling um, our investments from like mutual funds and GICs and all that into more dividend stocks. So that injection of fresh capital helped, right? So just looking at my dividend history in 2011, we got $675 for the whole year. And then in
That's a pretty good
2012,
start though, if that's like your first
it
or
was,
second year.
and then in 2012, we quadrupled that. We ended up with just under $2,500, right? So
Yeah. Wow. That's
and then in
amazing progress.
2013, we then doubled it to like almost $5,500, right? So we've been just like putting a lot of fresh capital into our portfolio, and then since then it has grown, and obviously compounding and stuff like that helps, right?
So those were some wild years in Vancouver, 2010 Olympics. I actually was a volunteer at the snowboard cross on Cyprus. Obviously, 2011 the Stanley Cup run, and so yeah,
That was
some wild times.
Yeah, Olympics was always a fun time. I think it was like 2 or 3 weeks. Got to
3 weeks.
some curling games. I mean, back then it was like I went to the semifinal game between Canada and who did we play? Paul Dimitrash. He's from who is I can't remember.
Can't
But
help you on
anyway,
that
it
one.
was
I don't know my curlers
men's
that well.
hockey semifinal, and Slovakia and Canada, and we won obviously because we won the gold medal, and
Oh right,
it was like no split seas, like over $200, and I was like, oh, that's so much money. And then I was
it's
like,
so much money,
but it
but
was
it's
an
a
experience.
lifetime
And then we
experience,
also
right?
like buddies of mine went up to Whistler to ski, and then we caught I think it was Super G or something, like Lindsey Vaughn. So yeah,
Right.
it was great time. And then the gold medal game we were watching in I think it was the Ukrainian Community Center in Vancouver, and then we were up by one, and then somebody started saying "Oh Canada," and we're like, "Shut it! You're gonna jinx it!" And then of course
Yeah, not quite yet,
the
not quite
Americans
yet.
scored, and we're like, "Oh!" And went to overtime, and then Crosby scored the golden goal, and
The goal.
everybody's like cheer, and then
Yeah.
we then walked down over Canby Bridge, and and then was like celebrating along Granville Street downtown, and that
I was
was
right because
absolutely.
I saw the game. I watched that gold medal game at Original Joe's that used to be on the corner of Broadway and Canby. And after
Oh
the
yeah,
game,
yeah,
we walked over the Canby Street Bridge as well. So
yeah,
we were in the
yeah.
same group.
And then Granville Street was just packed. Like
Yeah,
we
downtown
were
was
getting
crazy.
pushed by the crowds, and then everybody was happy and celebrating, and yeah, it was a great time.
I'm gonna pull up your website/blog here, and I know you talked about it a little bit
Mhm.
earlier on, but there's so much information here to go through. Right here, to show it's possible to achieve financial independence as single income family with two young kids while living in one of the most expensive cities in the world, which we've already alluded to. So there's that. Just so many incredible articles here that obviously there's so much to read. And yeah, REITs, I wanted to bring this one up. And you
Mhm.
have like the list of every Canadian REIT on here, I believe.
As much as I could find, yeah.
Right. So what are your thoughts on REITs? My viewers and listeners know that I really like my REITs for that monthly income, for that exposure to real estate without being a landlord. So yeah, let's just talk about REITs for
Yeah, so
a second, a minute.
we own a number of REITs, right? So get this is breaking news because I haven't disclosed this on my blog yet. I will do that in the next month's or July dividend income report, which I usually post a month later because yeah, I have to tally the numbers and write it, right? So usually I post like in August I post the July report and so on. So we
Right,
used to own Granite REIT, Vici Properties, which is a REIT in the U.S. that does like they basically own most of the Vegas Strip, like hotels and stuff.
right,
Dream Industrial REIT, RioCan REIT, and then Smart Centers REIT. We actually just recently closed off our position in Dream Industrial and RioCan. I do personally like REITs a lot because again, I'm not really interested in investing in real estate because I think being a landlord is a lot of work and have heard a lot of bad
yeah,
stories from friends that are landlords. So I generally speaking, I like REITs. Now REITs haven't done all that well this past year just because um, the macro economy and stuff. Now, why did we close out Dream Industrial and RioCan? I know Dave, you like RioCan a lot. I think from what I read. Um,
I do.
Dream Industrial because we got in really early on Dream Industrial, so we have done well on that particular stock. The reason I got out is because it hasn't really raised any dividends for many years, and the price has been kind of flat for a while. So we decided to get out of that. RioCan because it cut its dividends during the pandemic. It raised dividends um, I think a year or two ago, but the level is still not back to the pre-pandemic level, and the
Right,
price is kind of just chugging along lately. So figure like we got better places to invest our money than RioCan. Plus, we also own Smart Centers REIT, so RioCan and Smart Centers are kind of similar, right? Like the
yeah,
shopping mall.
exactly. I don't hold smart centers, and it's
Yeah,
pretty much for that
yeah,
same
so
reason. It's
so we
like,
figure we'll just focus on one rather than both of them, right? So we now, as of today, we own Granite, Vici, and Smart Centers. Um, it's a small percentage of our portfolio, so we're okay with that. But yeah, I do like REITs.
right,
Now with REITs, is they typically have higher yields compared to some dividend stocks. So and with the structured REITs because they usually pass up to 90% of their income. Um, you want to hold them in your registered accounts, right? So either TFSA or RSP, just to avoid the complication with the on the income tax side, especially when you're dripping. When you if you're dripping
Right.
REITs in a non-registered account, it's a bit of a nightmare. So
Right.
that's something that we keep in mind. Um, yeah, and then another thing with REITs is a lot of them don't, even though they have really high yields, they don't typically raise their dividend payouts that regularly. So definitely keep that in mind, right? So I mean, you could
Right.
start off with like a 5% dividend yield, and then it just sticks there at 5% versus if invest in, I don't know, Fortis with a starting yield of, I guess, 3-ish%, but if it increases payout every year at 5-10%, eventually that is going to cross that 5% yield rate, right? So that's something to keep
Right.
in mind as well.
Yeah, so I got into RealCan after that dividend cut a few years ago.
Mm-hmm.
So I kind of scooped in at a good
Yeah.
time because the price was
Yeah, so that makes
lower. I
sense,
didn't
right?
suffer
So
through the
yeah, that
cut.
makes sense for you. But for us, we've been investing in RealCan for a while. So different entry point, different mindset, right? So I think if I had got into RealCan during the pandemic at the low price, we would probably hold on to it. But for now, we decided to move to something else.
Right. And I just have this one highlighted here. I'm not sure if you're familiar or your thoughts on Northwest Healthcare. Their share price has just been getting absolutely hammered this last little while. I'm fearful of another dividend cut there, but what are your thoughts on Northwest
I don't
Healthcare?
follow them too closely. I mean they obviously focus on the Northwest. It's like retirement homes and nursing homes and stuff like that. As you know, that's been challenging during the pandemic, and that still continue to suffer. Uh, so yeah, so
Right.
that's where, and REITs is going through a bit of a change, right? So when you look at it, like we used to own H&R REIT, which is focusing mostly on office spaces, right? And that has done poorly over the years just because um, I'm still working from home since March 2020. So a lot of offices are not being used anymore, right? So um, that's where these office REITs are kind of pivoting and trying to
Right.
invest in other properties. So um,
Same with True North TNT,
yeah,
an office REIT that just went through. I think they slashed it by 50% their
yeah.
dividend, and obviously the share price
Yeah,
reflects
so
that
so
now
you
as
definitely
well.
need to
So
watch out which sector REIT that you invest in, right? So I like these
right.
industrial REITs because with online shopping, the likes of Amazon needs to have a warehouse somewhere central in within the city, right? So they typically would look for properties on these industrial REITs. I think shopping malls are fine because people need to shop. Despite online shopping, there's just stuff that you prefer buying. Like if I'm buying a tool, um, I would rather go to Home Depot and check it out rather than buying it online. Right? There's certain things
Right.
um, that you just buy at a brick and mortar place rather than online,
Yeah.
right? So yeah, so I think REITs are okay. I think um, a lot of dividend investors when they start out, they kind of look at that high yield and it's like go all in on REITs. So I would caution against that. Definitely watch out your portfolio, like your segment diversification. Because REITs are very tied to the interest rates, right?
Right. Yeah. Just a quick shout out here to the giant rubber duck. He looks like he's floating around False Creek there.
I think that's actually in Hong Kong, but I don't know. I find these pictures online and use them.
Really, that looks like the North Shore Mountains in
Yeah,
back.
I
But
don't
yeah, you're right.
know.
That doesn't look familiar right
Yeah,
there. Um, and then yeah, six best Canadian bank ETFs. Should I invest in one or build my own? So Canadian banks have a long dividend history. All big five banks, Royal, TD, BMO, BNS, and CIBC have been distributing dividends since actually mid to late 1800s. So yeah, let's talk about Canadian banks. Obviously, they're a fan favorite among the Canadian Div Twit community, and even a lot of Americans in the Dividend Twitter community.
Yeah, no, I think banks
So, yeah,
are.
go ahead.
I think banks are great now. Now on this particular post, obviously there are bank ETFs that whole banks. But my summary
Right.
going through them is there's no point holding them and pay MER. You are better off holding your own. I mean, it's not like there are a lot of banks in Canada, right? There's like the big five plus National Bank that makes the big six. Um,
Yeah.
you could just hold them on yourself and kind of um, create your own personal ETF, and that's what we're doing. In terms of banks, yeah, we like banks, Canadian banks in particularly, as mentioned by you. The big five has been paying dividends since the mid to late 1800s, uninterrupted, never cut. That's pretty impressive. Now they don't raise dividends every year,
Right.
um, and
It would be tough to
historically
year for nearly
Canadian
200
banks.
years, right?
Yeah, but Canadian banks are pretty well regulated. I mean, if you look at during COVID, they were shifting money to protect themselves, right? Like,
Right.
and then even now they're reserving a large amount of money in case any loans get defaulted. So they're pretty conservative. And then the other thing, if you look at like step back, looking at the big picture, um, like how many people do you know that switch banks regularly? Probably not that many people, right? So like
No, not often at
I
all.
bank with TD is because my parents banked with TD. There's a lot of these generational effect with Canadian banks. Is like the grandparents banks with Royal Bank, therefore their kids bank with Royal Bank, and their kids then bank with Royal Bank. You don't really
Yeah.
switch
Yeah.
that often, so there's a loyal customer base, right? So they could expand that base, and then the business model is pretty easy, right? You hold somebody's money to make money. You people deposit their money in banks, and then the banks then loan out money to make money, right?
Right.
Easy business model, and for banks to there are a lot of levers they could use, right? So if they need more money, they could either increase the monthly fees by a little bit. All of a sudden, they got a little bit more revenues, or they raise the minimum checking balance, from like 1,000 to 2,000. All of a sudden, they have quite a bit of money lying around, right?
Right.
So that's something that's pretty nice. I know a lot of people are worried about this whole housing crisis and banks and stuff like that. Yes, that's worrisome, especially with the interest rate going higher. But again, in Canada, we have like the mortgage insurance, so people need to pay certain, like I think certain percentage to a down payment, um,
Right.
and then if you look at even bigger pictures, a lot of the pension funds and retirement savings, or dividend investing ETFs are investing in these banks. If they were to go under, man, like Canada as a whole is going to be in such big trouble, right?
Yeah.
So the
Luckily, that's not happening
that
anytime
that
soon,
will
right?
not happen. If that were to happen, I mean, the government will come in and rescue these banks for sure.
Right.
So I'm not too worried about the banks.
So I'm just going to quickly, like, we've just really scratched the surface here on your blog. So the start here, beginner articles, intermediate articles, advanced articles. You have a coaching tab here, financial independence, sort of what is it, or what does early retirement look like, dividends, and you have a whole whack of links there. ETFs, same. So obviously, in the recommendations over here, stuff we love, blog roll. Obviously, I will put the link in the description below so you can check out. Uh, how are you pronouncing that? TAWCAN?
TAWCAN,
At
yeah,
TAWCAN.
yeah.
So yeah, you can check out TAWCAN yourself when I with the link in the description below. And I'm also going to pull up this one quickly. Can you see that? Is that your Twitter page up there now?
Yeah,
So I congratulations. I see you've recently just went over 10,000 followers on Twitter.
thank you.
And yeah, X. I can't. It's not Twitter anymore. It's X.
Yeah,
But we're gonna call it Twitter for another 10 or 15 years, right?
yeah.
So yeah, you can same handle at TAWCAN, TAWCAN, and follow Bob over there on Twitter or X or whatever you want to call it.
Yeah.
And definitely some great tweets and great content on your Twitter uh, handle or profile as well. So
Thanks.
awesome. Like I said, that your website slash blog, there's just so much information there, and we just literally scratched the surface just talking about a couple of my two favorite topics, really being selfish, talking about REITs and Canadian banks. But there's obviously so much more there when at the end you saw me scrolling around the links. So yeah, I see, like you said, 9 years worth of work going into that, and yeah, I believe it because there's so much content there.
Yeah, and I've been for the last, I don't know, 3 or 4 years, I've been doing a pretty consistent publishing schedule. So I publish every Monday, like an article every Monday. So, lots of writing, thinking ahead,
Yeah,
planning, and thinking about what to write and stuff like that. So it's a lot of fun. It's a lot of work as well, right? So as you can
yeah, it's a lot
imagine,
of work,
yeah.
but it sounds like you have great interaction with your community as well. So that's impressive.
Yeah, it's nice, and it's kind of funny because now people at work know about my blog as well. I mean, I was featured on several uh, like online medias and even magazines. Um,
Right.
so I mean, years ago, I got featured on the Money Sense magazine. They did an article on me, um, and then I've been on various other
I think I
websites.
even saw a link to your blog once from yahoo.ca or Yahoo
Yeah,
Finance. Yeah.
Yahoo, or I can't remember. There's like
Yeah.
Business Insiders, you know, bunch of stuff. So like, it's funny because I was at work the other week or last month and just walking around in work, and then somebody I didn't really know came out, saw me. I was like, hey, I read your blog, and I was like, oh, who are you? Thank you.
Yeah, that you're like, this is weird.
Yeah, and that's why I don't. There's certain things I don't share on my blog, right? I don't
Right.
disclose our portfolio value or how many shares we hold per stock, just to keep that privacy
Yeah.
thing.
No, that's
And
fair enough.
if people think that I'm just making up stuff, like, so be it, right? I don't think, having written over 9 years, I don't think I need to prove myself at this point, right? Like, I'm
Yeah.
just sharing our journey and try to help out other people, and pumping out material people could read. Now, if you're thinking I'm creating a fantasy site or whatever, that's your problem. I don't really care at
Yeah,
this point.
that's your prerogative if you, yeah,
Yeah,
I get
yeah,
that. So,
and like, if you think it's only true if I show you our like, portfolio value, or receipts of our dividend income, like,
right.
really, like, do I really have that much time for the last 9 years to build up a fantasy side? I mean, come on, right? So that's kind of silly. And yeah, it's funny because certainly my boss knows about my blog, and his boss knows about my blog. So there's been a few people in the company, and even like, just coffee coffee room or water cooler talk. It's like, hey, what do you think about this investment, kind of thing? Because they know I know about it, right?
Right.
So it's kind of
Yeah, yeah.
funny, yeah.
And you're like, it's not financial advice.
No,
I'm
no,
just a
no,
guy
and
talking.
it's funny, right? Because they're like, oh, like, what are you doing right now? What do you think about the market? What's going on? Kind of thing. I was like, oh, this is what I think, but I'm not
Yeah.
and like, I'm not, I don't know, I can't read the future, so this is what I think. They're like, oh,
Yeah,
okay.
this is
So
just my opinion,
yeah,
right?
so it's kind of fun, kind of cool that way.
Any other sectors that you want to discuss?
Um, no, I think overall the market's been, I guess, overall up in the last year. I know the banks are kind of, well, I mean, depending on which bank, they've been kind of volatile. Yeah, I think going back to what we talked about, right? It's I think if you really need to think about long term, right? And then the
Right.
other thing to remember is if you're in the accumulating phase, what you want is actually a bear market.
Yeah. The lower
Because
the price, the better.
you could get stuff on a discount. When you're
But with that
accumulating, what
said,
you
too, you just got a dollar cost average in, whether it's a bear market, a bull market.
yeah. So you don't really think too much about whether the market is up or down on a daily basis. It's about you like long term, right? Like historically, the stock market has like an 8% return. Now it's not 8% every year, but over the long term average,
Right.
it out is 8%. So just keep that in mind. Um, and yeah, it's about having a strategy and keep on there, right? So an analogy I kind of use and I wrote about it on the blog years ago was uh, get in line, stay in line, right? So if you think about if you're at a grocery store cashier checkout, um, you get in line. If you switch line, doesn't necessarily mean you'll get there faster, right? The person that's getting checked out has taken his or her time or their time to stay in line and get to the front of the line, right? So you need to really take that time um, and wait for your turn. And similarly for investing, is that if you're always constantly switching in and out of the strategy, so you could be like, oh, I want to do growth investing, so you go, growth investing, and then it's like that's not doing really well, so you then switch to dividend investing, and then you're not seeing the result, and you jump to like I don't know Bitcoin investing, or you go into real estate. You're jumping when you're constantly jumping in and out of different strategies. That's where you get into trouble, right?
Yeah.
So the idea is that you stay with develop a course investment strategy, whether it's dividend investing, whether it's ETF, whether it's real estate investing, whether it's investing in businesses. It's fine. Invest in something that you understand and you're comfortable with, right? So a lot of people, even with my coaching clients, even though I write about dividend investing, I've been telling people, especially when you're starting, invest in index ETFs. Don't make the mistakes I did and do
Yeah.
put all your money in one basket. Um, Invest in index ETF and index ETF. So there's like these all-in-one ETFs late in the last few years, like the VGROW, XGROW, XEQT, VQT. Those are awesome, right? So
Right.
invest your money in a well-diversified index ETF, build up your base, make sure you're diversified first. Then if you want to sort of nibble on dividend stocks, then you could do that because then you have a diversified portfolio already. So, it's about staying that with a key strategy. Once you amass a decent amount of money, then you could start thinking, okay, what other complementary strategies I want to do.
Right.
Like, for example, if you're doing index, like I said, and you want to go into dividend investing, sure, then you could start doing that. Or if you want to start doing real estate, then you could do that, right? So
But not
again, you
switch lanes
can
completely. Like kind of get
exactly
into
don't
one
don't
lane, get
switch like
comfortable. Yeah.
yeah, just stay with your strategy for long-term strategy, and then have these supplementary strategies if you want, or just don't jump back and forth. That's
It's like
when
bridge traffic in Vancouver, right? You're the
yeah,
Lionsgate
or
Bridge. It doesn't really matter which lane you're in. It's going down to one lane eventually if you're going right.
yeah,
So
or when you're stuck in a traffic, it doesn't really help to go back and forth and switching lanes, right?
yeah.
You probably end up getting there the same amount of time. So that's something that I've written about and mentioned quite a few times on the various mediums.
One more sector I want to quickly touch on um, is the Canadian telecoms, Bell, Telus, Rogers. That fourth
Mm-hmm.
one coming into play, uh, Quebecer slash Videotron with that whole other deal that closed last spring. But really, my thoughts are on Telus right now. I don't hold any Telus myself, but right, they've been trading around that 52-week, and so the stock price has just been getting hammered. Same Bell stock price, BCE is relatively low to its 52-week highs as well. So, um, just your thoughts on the Canadian telecom
Yeah, and
sector.
that's not just Canadian, right? So if you look at the likes of AT&T, Verizon, they are also being hammered, but maybe that's a little bit different story. Excuse me. I think with TELUS and Bell and Rogers, I mean, Bell and Rogers in particular, they don't just own telecom businesses, right? So
Right.
they also have media business, and that's dragging them down quite a bit. It's not easy to make content, right? You look at Bell Media; they've been laying off people, closing down because they own like radio stations and other media like TV stations
Yeah.
and stuff like that. They've been laying people off and try to streamline that particular area. It's hard in the media business, media content generating business. Similarly, Rogers too, right? Like
Yeah.
I think they own, can't remember what they own, but they closed down quite a few radio stations over here in Vancouver. Because it's tough. Like you look at Disney, right? They came out with this Disney Plus that's doing okay, and even you look at Netflix, it's doing well, but look at how much money they're injecting into that business for creating new content, new
Right.
shows, new movies and stuff. It's not easy, right? So that's dragging both Bell and Rogers down a bit. Now on the telecom side, um, it's it costs a lot of money to maintain the network infrastructure. It also costs a lot of money to invest in new technology. So as 5G becomes more and more prominent, um, these telecom companies need to invest in new 5G networks, right? So
Right.
um, I just happen to work in the call it cellular network businesses. So even with 5G, um, a lot of the carriers they're still using the LTE core network. They're not they're not investing that money to build up the 5G
Right.
infrastructure. So they're still piggyback on the existing LTE core network, and that makes sense as they spent years investing LT towers and stuff like that, right? So for them
Right.
to, imagine to build out a new 5G core network across Canada, that's going to be a lot of money to
Yeah.
invest. So that's part of the problem. They're slowly, building that core 5G network across the nation, like in Canada for these telecoms, and then in the US as well. But with the interest rate going higher and higher, that's obviously they have debt, so that's causing a bit of drag on the
Right.
overall profitability, right? So that's kind of why we're seeing a bit of poor performance um, this year for the telecoms, right? Um, Now going back to what we talked about, if you're just accumulating, this is fine. Like
Yeah.
but if you again step back a bit, um, I like to look at the big picture when I do these investment thesis or studies. If you look at the big picture, um, what do Canadians complain about a lot? High cell phone bills,
Yep.
right? If you travel outside of Canada, like Europe, Asia, or even in the US or South America, you'll find that cell phone rates are way cheaper than Canada, right?
Yeah.
So, um, I was over in Taiwan for business, and um, actually had to quarantine. This was last year for 4 days, and it was mandatory to get a SIM card for they want to be able to track you where you are for the first week. So I got a week worth of like a prepaid SIM that's good for a week, and it was unlimited data. Guess how much it was?
$5.
Yeah, yeah,
Yeah.
around that. So like that would cost like an arm and a leg in
Yeah. In
Canada,
Canada
and
for a week of unlimited
yeah,
data, it would be probably close to $100 is what they would charge.
yeah. So similarly in Europe, my wife's from Europe, so we go back there um, every so often, and we usually get a prepaid SIM, and similarly, it's like super cheap,
Right.
right? So like that, like knowing how much we pay for data and people are addicted to data. I mean,
Yeah.
you know, you
Everybody's
see.
got their, staring at their cell phone, and
Yeah, so
kids
so
8,
from
9,
that
10
point
years
of
old.
view, I think telecoms makes sense to invest. They're almost similar to utilities now. It's just like very
Right.
stable. Obviously, there are challenges. They need to grow their subscriber base, and things like that. It's
Right.
difficult, but you're also seeing them diversifying outside the telecom, right? So you look at TELUS, the TELUS Health now that
Right.
hasn't done well. That's why that's dragging down TELUS
Yeah.
in the last month, because I think TELUS owns like 80% of that company. Um, but they're also diversifying, like TELUS. They're getting to like home security, for example, right? You
Right.
see TELUS and Rogers is like, oh, you can use home security cameras or stuff like that, or alarms, and so they're getting into other space, kind of complementary of their telecom
Right.
sector, right? So they're as they expand, I think that will be very interesting moving forward.
Just quickly, do you hold any of the telecoms in your portfolio?
Yeah, we used to own Rogers, O3, right? Rogers, Telus, and Bell. We closed out Rogers a few years ago during that whole Rogers fiasco with the
The
CEO and the
family.
board. Yeah, the families over like screw this. I'm focusing on the other two. Just kind of not diversifying, but just like concentrating on the other two. We used to own AT&T, and then years ago we sold AT&T because that's just not doing anything. It's a bit of dividend trap. And then we used to own both AT&T and Verizon, so we only sold. I think I sold Verizon like a long time ago, and that the only reason we got into Verizon because we used to own Vodafone, and when Vodafone used to own part of Verizon, bit of story, um,
Yeah.
and they closed out some restructure, and that's how we got a bunch of Verizon um, shares, and then we sold it, and then focused on AT&T. AT&T wasn't doing too well, a bit of dividend trap, and then so I used that money to invest in Verizon, and then a few months ago we decided to get out of Verizon because again that's a bit of a dividend trap as well.
Right.
Um, and then Vodafone, we used to own that as well, sold off. So over the years, um, learned a few lessons on what to invest in, right? So,
Yeah. Yeah.
for now, we own Bell and Telus in our portfolio, and we plan to continue to hold those two.
Yeah, I only have Bell, and actually, I just started a position at the beginning of this year. I'm in dollar cost averaging in, so my position is still quite
Mhm.
small. But I obviously it's nice when every quarter you see that dividend payment going up because you are buying more shares. But yeah, I'm obviously very tempted to start a position in Telus because that price is quite attractive right now.
Yeah, and what we're doing is we're dripping. We hold Bell in regular in TFSA, and then Telus in I guess regular is called non-register as well. Non-register RSP and TFSA, right? So we hold them in various different accounts, and in every account we're able to drip. So the idea is just drip over time and dollar cost average. Um, so that's the idea, and see what happens, right? So
Yeah.
I don't have any concerns with telecom at this point.
Okay, Bob, are you ready for the hard hitting question? You and I are both Vancouver Canucks fans. Are
Sure.
the Canucks a playoff team this coming NHL season?
Hmm. That's a tough question. I'm optimistically saying yes, because
Cautiously optimistic.
they upgraded their defense. That's been their
Achilles heel.
Achilles heel over the last few years. They got rid of EOL, um, whom I don't know. I think Jim Benny screwed up massively on that
I
one.
agree on that one.
Um,
Yeah.
so I'm confident in the new management. They seem to know what they're doing a lot better than Jim Benny, fortunately. So yeah, they upgraded their defense now. Danko should be better than last year. He was injured, and did poorly the first half. When he came back from injuries, he played a lot better. And then in the front, I think they got a bunch wingers that are doing pretty well. Now they need to find a third line center. I don't know if they found one through free agency, but I think they could make it. With the new coach, they're playing a more tighter system than a loosey goosey under Kudrow, Boudreaux, and yeah, it should be interesting. Obviously, the Pacific is pretty tough with Vegas winning the Cup this year. Um, you know, LA is doing pretty well. Edmonton has McDavid. Calgary, we'll see what happens with Calgary.
Right.
And then Seattle is doing well too, right? So
Yeah.
whether they could crack that playoff spots, we'll see. But I'm optimistic, so we'll see. It's going to be interesting, though.
Yeah, I agree with most of your points there. Demko should have a better season. You have basically all stars in Quinn Hughes and Elias Peterson. So you've got like three, a center and a defenseman and a goalie that are pretty much all-star calibers and possibly even, could, Vezina possibilities for Demko, Norris potential for Hughes, maybe Selke potential for Peterson. So you've got some great players there to build around. Obviously, JT Miller as well is an incredible point per game player, and it's just can they pull the rest of the team up with them?
Yeah,
and then I was just going to say I agree with your other point too. Is with the all those other teams in the Pacific, LA, Seattle, Vegas, Edmonton. Who do you knock out to get your spot in there? Right, that's the real tough.
Yeah, and they need to trade a few players to gain some cap space, right? So like Myers, he's obviously signed for way too much money. So if they could trade him, or it's his last year contract, so they could get out of it after this upcoming season. But there's just it during Jim Benning era, it was.
A lot of
cap was poorly managed, and coming from a personal finance point of view, it's like, what are you doing? You're not protecting your assets. You're handing out these stupid contracts to third liners and fourth liners and bottom defenders. It's like, that was bad. So just poorly managed. But we'll see what happens. Obviously, we're all pretty passionate with hockey, with us, everybody. So, should be interesting. But all the Canadian teams are kind of struggling a bit. Right? You look at Toronto; they have their issues. Yeah.
Okay. Well, with that said, we're not going to turn this into a hockey podcast. Although now I feel like maybe I should start another podcast just to talk about hockey as well. But maybe for another time. Wow, I see we're quickly approaching an hour here. I again thank you so much for your time and coming on here, Bob. Before we sign off, any final words or final thoughts?
Again, thanks for having me on. I know it's took a bit of back and forth to figure it out. It's always happy to chat with other like-minded folks on investing or personal finance in general. Listeners, readers, feel free to reach out to me. Easy to get a hold of. Send me an email or send me a message on Twitter. Twitter has been kind of weird because with all these changes, sometimes I don't get the ad notification from time to time. But usually emails are the best via my website. And just investment is not a short-term thing, right? So really, again, I like to take it the big picture view is set up your target, have that big picture, and then kind of break down your progression into small goals, right? It's little steps, right? And then celebrate those successes, small successes along the way, right? So it could be I had $1,000 in dividends. Great, let's do a little celebration, or
Yeah, yeah.
it's important to do that because it's a long haul, right? Like we've been investing for over a decade. We've been on our FI journey for over a decade now. Yeah, close. Yeah, 2010. Yeah, over a decade. Um, and you hear these stories about so and so achieve fire in less than 5 years, and it could be a bit discouraging, but those are pretty rare, right?
Right.
And it takes time. And the thing, for me now is that we know we'll get there eventually. I mean, there's this coast fire thing where um, it's like a sub fire. There's so many different types of fires. So coast fire is where if you have certain amount of money by certain age, you'll be fine
Right.
at 65, right? So you don't have to contribute more money. So we're past that coast fire stage, but we know we'll get to whatever the 60,000 in dividend eventually. So we're not in a rush to get there. Um, and I think it's just important to keep that in mind, is that you don't have to rush to get to that so-called finish line.
Right.
And a lot of people kind of think that finish line is like the magical thing to cross. Is like, and they put that on a pedestal a little bit. It's like, oh, if I'm not happy with my work today, and so on and so on, I'll be happy once I get to that point. Is that, well, no, it's a journey. You need to really
Yeah.
work on yourself. Just because you reach the finish line doesn't mean magic will happen. Your life will be super happy and every is rainbows and sunshine. Right? It doesn't work that way. You need to work on yourself and improve yourself along the way and change how you see things. Right. So that's been a really good lesson for me over the years. And just again connecting with other like-minded people, just because I've been talking about investing for the last 9 years, and I seem to be like, people call me an expert. I'm not an expert. Like, I just talk a lot and write a lot about investment. I'm still learning things on a daily basis. it's,
Right.
it's awesome, right? Or even talking to my kids, like teaching them about investment, and they're like, oh, but what do you mean by this? Why isn't it this way? I'm like, oh yeah, I never thought about that, right? So it's
Right.
kind of interesting when you start interacting with other people and they kind of see things from a different perspective. I think that's very, very beneficial, and a great learning method, right? So just because you've been investing for 10 years, don't just reject new ideas. I think that's what I learned over the years. And no, I know on Twitter there's like a lot of, I don't know why lately there's a lot of like index versus dividend debate, and people get really heated, or like advisor versus non-advisors, and advisor versus like influencers. That's what they call it, and it's like so on and so on. I think recently there was like one about how like influencers need to get regulated, and so I'm just like, end of the day, it's like we're all trying to help people to do better financially, right? That as long as we're not um, defrauding people, and ultimately as long as we are trying to help people to our best ability and not trying to like trick people,
Right.
I think that it's all good, right? So let's have a healthy discussions, and not set our mindset to this is the way, it's my way or the highway. That's not very healthy, right? It's that
Right.
that's be more collaborative, and be open to other ideas, right? Now some idea might not make sense, like investing in cannabis stocks, right? Like, but like sure, that's an idea, but educate those people is like,
Right.
why is it not a good idea, and have that healthy discussion instead of just shutting down
It
saying, yeah,
looked
you're
like a
stupid.
cannabis stock looked like a great idea about 5 years ago, to be honest. And 5 years
Yeah,
later,
but
well,
but
you don't.
yeah, but like, don't just shut people down and saying like, and
Yeah.
start labeling and saying, oh, you're investing in cannabis stock, like, are you stupid, or right? It's like, okay, and everybody has different stories and where they're at, and everybody's different, right? So try to be in somebody else's shoes rather than just start attacking them and pointing fingers. I think we could all do a little bit better with that. Everybody.
Yeah, a couple of great closing thoughts there. Take a long-term approach, never stop learning, and basically treat other people with respect. Is sort of what I'm hearing there on your final few thoughts. Again, thank you so much for coming on and spending time with me here on this episode of the Passive Income Podcast. I see we're well over an hour. I feel like we could have talked for
Yeah, we
hours.
could talk
We
for
could keep going
more.
for hours on end and keep
Yeah.
talking all day long about investing in dividends and hockey and the Olympics and Vancouver and everything. But yeah, thank you so much for your time, Bob. It's been an absolute pleasure speaking with you here on this episode. And if you are still here well over an hour later, make sure you join the Passive Income Posse and click that subscribe button below.
Thanks for having me